If you've ever invested, you've probably felt it, this pull between two different minds. One side of you is a cold, calculating mathematician, and the other, well, that's a fallible, emotional, unpredictable human being. Today, we're diving deep into the epic battle between these two minds, a conflict that really defines what it means to be an investor today.
So here's what we're going to do. We're going to explore this tension by looking at a huge idea from one of investing's giants. Then we'll look at the counter-argument from a modern master of financial psychology. And finally, we'll bring it all together to give you a really powerful new framework for your own financial life.
See, at its heart, success in investing really just comes down to managing this internal conflict. You've got the rock-solid, irrefutable logic of numbers on one shoulder, and then you've got the complex, often messy reality of human nature on the other. And pretty much every big money decision you make is a tug-of-war between these two.
So let's meet our two champions. In one corner, you've got the late, great John Bogle, the founder of Vanguard. He built an entire empire on the unshakable foundation of simple math. And in the other corner, you have Morgan Housel, author of The Psychology of Money, who argues that how we behave, not our skills with a spreadsheet, is what really decides our financial destiny.
So which one is it? What's the real path to wealth? Is it the cold, hard logic of a calculator? Or is it understanding the warm, often irrational pulse of your own psychology? Well, let's start with what seems like an unbeatable case for the numbers.
John Bogle's entire argument can be boiled down to this. Winning at investing is basically a solved problem. He believed the solution isn't in some complex strategy or brilliant stock picking, but in some very simple, irrefutable math. And Bogle's revolutionary tool to do this was the index fund. The logic is just beautiful in its simplicity. Why would you waste time, money, and all that energy trying to find the one winning stock, the needle in the haystack, when you could just buy the entire haystack for a tiny fraction of the cost? You are guaranteed to get the market's return.
This one phrase right here, it captures Bogle's entire philosophy. He argued that in the big race for investment returns, there's one giant hurdle that trips up most investors: cost. He was convinced that the simple math of fees is the single biggest factor in your long-term success.
And this chart just lays it out perfectly. So let's say the market returns 7%. A high-fee fund, maybe it charges you 2% in fees and other expenses. Boom, your return immediately drops to 5%. An index fund, though, it might only cost a tiny fraction of a percent. Over decades, that 2% difference isn't just a 2% loss. It's a catastrophic loss of compounding growth. The math is, well, it's relentless.
And hey, don't just take Bogle's word for it. Warren Buffett, who is arguably the greatest active investor of all time, has said again and again that for almost everybody, Bogle's low-cost index fund strategy is the smartest way to go. The mathematical case seems pretty much closed, right?
But this leads to a really fascinating question. If winning is as simple as just buying a low-cost index fund and then holding on for dear life, why is it so hard for so many people? Why do we so often fail? Well, that brings us to the other side of the brain.
And this is where Morgan Housel comes in, painting a totally different picture. He argues that the biggest risks in finance, they're not in the spreadsheets or in the economic forecasts. No, the biggest risks are staring right back at you in the mirror.
Housel tells this incredible true story of Ronald Read, a man who worked as a gas station attendant and a janitor his whole life. He never had a big salary. But through decades of patient saving and investing, he built a fortune of over $8 million. Now, at the same time, you have these highly educated, super well-paid executives who have gone completely broke. The difference wasn't smarts, it was behavior.
Think about it. A spreadsheet can tell you the historical odds of a 30% market crash, but it has no way of computing that gut-wrenching fear you feel when it actually happens. That feeling when you come home, look at your family, and wonder if you just jeopardized their future. That feeling, not the math, is what makes people panic and sell at the absolute worst possible time.
And this brings us to Housel's central idea. The goal isn't to be coldly rational. The goal is to be pretty reasonable. See, a rational strategy might be perfect on paper, but a reasonable strategy is one you can actually live with and stick to when things get terrifying. And sticking with the plan is what really counts.
And get this, this might be the most powerful story in all of finance. Harry Markowitz won a Nobel Prize for creating the rational way to build a portfolio. So how did he invest his own money? He just split it 50-50 between stocks and bonds. Why? His goal wasn't to maximize his returns. His goal was to, quote, minimize my future regret. Even the father of rational investing made a reasonable, emotional choice for himself.
So, let's bring this conflict into the real world. Let's pit these two ideas against each other. This is really the battle between the perfect logic of a spreadsheet and the messy, emotional conversations that happen around the dinner table.
Okay, just look at this table. When the market crashes, the rational move is obvious. Buy more. Stocks are on sale. But the reasonable person might say, you know what, I need to sleep tonight. I'll sell just a little to dial down the anxiety. Or, rationally, it's probably better to invest extra cash than pay off a low-interest mortgage. But the reasonable person values the peace of mind that comes from being totally debt-free. A spreadsheet says your kid's startup is a terrible bet, but your heart says supporting your family is worth the risk.
And here it is, the ultimate twist. John Bogle himself, the king of low-cost, rational investing, admitted that he put some of his own money into his son's actively managed high-fee fund. Why on earth would he do that? He said it was for family reasons. In his own words, life isn't always consistent. Even the ultimate mathematician was, in the end, a reasonable human being.
So, where does that leave us? How do we take these two incredibly powerful and kind of competing ideas and actually build a strategy that works for us, for a lifetime?
Well, the big insight here is that this isn't a choice you have to make. It's not Bogle or Housel. The best, most durable strategy is a blend of Bogle and Housel. You use his irrefutable math as the foundation of your plan, and you use Housel's psychology as the guide that keeps you on the road.
So, here's a simple three-step framework. First, set your foundation with Bogle's principles. Build the core of your portfolio on low-cost diversified index funds. Step 2, run that whole plan through what we'll call the Housel filter. Ask yourself, honestly, can I stick with this plan when things get really tough? Does it let me sleep at night? If the answer is no, you adjust it until it does. And third, define what enough actually means for you. This is how you beat the dangerous comparison game that Housel warns us about.
Because ultimately, as Housel says, this is where it all really happens. Finance is deeply, deeply personal. Your goals, your fears, your family, those conversations matter so much more than any formula in a textbook.
So let's wrap this up. The takeaways are pretty simple. First, master the math. Keep your costs as low as you possibly can. But second, know yourself. The best plan in the world is useless if you're going to bail on it in a panic. Aim to be reasonable, not perfectly rational, because the best plan is the one you can actually stick with. Your strategy has to be personal to be sustainable.
And that leaves us with one last question for you to really think about. What's one financial decision you make, one rule you follow that might not pass a cold, rational spreadsheet test, but is perfectly reasonable for you and for your peace of mind? Thinking about that is the first step to building a philosophy that will truly last a lifetime.